Last year, bond turnover hit a new high in South Africa, despite non-resident turnover coming in at 5.3 trillion rand, just below the 5.8 trillion rand in 2007 and 2008. Joining us in studio now to discuss the outlook for portfolio flows in 2012 is Leon Myburgh, Sub-Saharan Africa Strategist over at Citi. Thanks so much, Leon, for joining us this afternoon. So we've seen the JSE see a good year for the bond market over the 2011 period. And as I said there, we had turnover hitting a new high for the period. Give us your assessment of the year that was.
Well, certainly, the turnover was high, but of course that was a function of volatility. It was a function of global uncertainty. You had these big spells of risk on and risk off that came through, and that boosted the role that the non-resident accounts were playing in the local market. And all of that would have contributed to relatively high volumes. So from a JSE point of view, certainly it was a good year for them. Very high turnovers posted, and also just from a development point of view for the market, it was good that we saw this big turnover.
Absolutely. There are distinctions, though, that need to be made in terms of what kind of investor actually participated in this market, because non-resident turnover came in at only 5.3 trillion rand, and that below the 5.8 trillion that was recorded, as I said earlier, in both 2007 and 2008.
Yeah, I mean, a lot of it is in the speculative and the interbank market type of trading where we see that, where lots of banks have been taking positions, against each other's, and we've seen also local investors, quite active in the market, and they've been quiet for the early part of the year. They were relatively quiet, but they picked up quite a bit of activity towards the end of the year. So, when you look now at the market, I would argue that as you approach the end of the year, things had quietened down a little bit. We saw that the speculative traders had sort of moved to the sidelines. We saw that the positions that were being funded by traders had become a lot smaller, and it sort of puts us at a clean slate for when we look ahead for this year in terms of positioning.
So let's look ahead. I mean, moving into 2012, is it simply a case of more of the same, or are you anticipating quite dramatic shifts within this space?
Well, I think the volatility could remain relatively high. I think we are in a situation where on a relative value basis bond yields are marginally attractive, mildly on the cheap side. I wouldn't get too carried away with it, because we do have headline inflation that's going up. We do have lots of uncertainty about what's going to happen in Europe. But while that has been said, we've got a very steep yield curve. You're funding your bond positions at sub 6%, but you're earning 8-9% depending on which part of the curve you go into. And that sort of reflects what we saw, for example, last year, where lots of the purchasing that the non-residents did took place in the 5 to 15 year part of the curve, which is sort of at the apex, a steep part of the curve. And so when we look at this year, I think we're going to see more of the same. We're going to see, there is still money flowing into it. It's quite, obviously it quietened down during December, but the outlook for flows into emerging market bond funds is okay. I wouldn't say robust, but it's okay. And also there's a relatively high pool of cash amongst the foreign investors who had sort of sat to the sidelines in the back end of last year. So I think this money is going to look for a new home, and we're going to find some purchasing taking place again of South African bonds during the course of the year. But I would moderate my expectations from where we saw around about 42 billion worth of bonds that had been bought by foreigners last year. I think one could probably scale that down slightly this year. And that was already down from the previous year, where it was 52 billion rand. But I think we'll still see some inflows, and the local funds, I think, will also use the high yield levels to accumulate. But yeah, I think it's going to be relatively quiet from a flow point.
Of course, what would influence that appeal moving forward is outlook on rates. I mean, we've seen rand weakness coming through, standing as a risk to inflation. But for now, we've seen inflation rising primarily on a headline basis as opposed to on an underlying basis. So what's your outlook on rates and the stance the SARB is set to take moving forward?
I mean, you've hit the dual story there. The headline story of inflation is not good. We're heading above 6%, and it looks as though it's going to be relatively high for the next 3 to 6 months, and that doesn't bode well. But when you disaggregate it down to what is actually driving this, is being driven by food and particularly food inflation. Because when you look at the underlying components, it's actually been remarkably well behaved, much better than what I'd expected, and certainly I think better than what many in the market had expected. It is going up, but very, very incrementally.
Yeah.
Now that sort of sits back when the central bank looks at that. They say, well, we don't really have to respond to this from an interest rate point of view, because there's no real signs of second round inflation. So It means that the central bank is likely to stay on hold for longer, than what we thought. As long as core inflation measures are well behaved, I don't see much change in policy. So you've got this case where, yes, your real rate starts to get compressed because you've got to deflate it by headline inflation, but your cost of funding is going to stay low for a long time.
So you've got elevated confidence levels when it comes to the sustainability of the good behavior and that kind of trend that we've seen.
I think so. We don't. The world dynamic at the moment doesn't really support a massive escalation of second round inflationary forces. I can't see, we've still got very high levels of unemployment in this country. We've still got relatively low levels of productive capacity utilization. So yes, there are certain cost push elements which raise a concern, and one needs to be worried about them. But at the same time, the general market behavior seems to be relatively seems to be pointing to that the current increased inflation isn't going to permeate into significant second round inflation. I think there will be some. I mean, I don't think one should say that there won't be any at all. There certainly will be some, because as we approach the next wage negotiations towards mid-year, certainly people are going to be looking at headline inflation. They're not going to be looking at core inflation, and there will be demands for higher wage increases. But I don't think that we're in a train smash in so far as the inflation picture
Leon,
goes.
before we let you go, let's take a quick look at that depreciating rand. I mean, as a result of waning confidence, we saw the local unit drop, 23% against the dollar last year. Currency volatility has been a concern for the longest while. Can rapid flows in and out of the country, be managed on a more rigorous basis, in your view, so that the country can weather any international fallout if it does occur?
Well, one probably needs to look at the nature of the flows, and often these rapid flows that swing in and out are more related to the speculative type flow, and often the speculative type flows are actually funded out of rand. They're not actually funded out of dollars, so it doesn't have a currency implication, at least not directly. There's of course an indirect currency linkage, because if people are selling our bonds, they're probably bearish on South Africa, and therefore the rand is going to weaken as well. But that you won't actually manage through trying to control the portfolio flow component of it. That would have to be done through broader macro-prudential guidelines for the economy. So I think, overall, the behavior that we've seen of the real money investors, the guys who've come in and actually sold dollars, bought rand, and those investors have generally been much more stable in their investment patterns, and I don't think that they actually pose a significant risk from a currency point of view.